As promised, we want to share a variety of plan options available to you before your renewal. Most companies in the small employer segment provide a traditional or fully insured plan, where an employer pays an insurance carrier a premium every month and the carrier bears the risk and responsibility to pay all claims incurred. For those employers who are able and willing to accept more risk, self-insurance may be a better way to fund their medical insurance plan. In its simplest form with self-funding, an employer absorbs a limited amount of the financial risk from the insurance company and pays a predefined portion of each medical claim for those covered under their plan. There are three main components you should understand when evaluating whether self-insurance is right for your group. They are fixed costs, claims cost liability, and contract provisions. The fixed costs are exactly that. Fixed and recurring monthly costs built into a self-insured employer's expected expenses and, depending on the number of employees, can represent anywhere from 10% to 40% of an employer's annual budget. Fixed costs typically fall into two categories: administrative expenses and insurance expenses. Administrative expenses are generally charged per employee per month and apply to things like claims processing, eligibility management, and network access. The insurance expenses are for high claim protections in the event of a large single claim, also known as specific stop-loss insurance, or an overall bad year of claims experience for the entire group is an aggregate stop-loss. The second major component of self-insurance is the cost of claims. Since we cannot look into the crystal ball, underwriters will review historical data, census information, and plan design in order to project a claim total for the upcoming year. The only certainty about this claims estimate is that your actual claims will either be greater or lesser than this projection. The smaller companies are less predictable and therefore less accurate and harder to estimate future claims. This claims estimate is the risk and the reward for a self-insured employer. If the actual claims are less than expected, you gain the reward, and vice versa. If you have a bad year of claims and exceed the estimate, then you'll have to pay the higher costs, thus the risk. Given the uncertainty of claims, cash flow is essential when you are self-funded. Since the self-insurance is a generic term representing a broad menu of options and risk positions, our goal is to first understand an employer's risk tolerance and then present a plan design that does not expose an employer to too much risk or unfavorable cash flow terms. The final and most important, but often least understood component is the contract provisions. To examine all the potential contract possibilities is daunting and beyond the scope of this video, but it may help to explain one such contract provision in a little more detail. Every stop-loss contract must define the details of coverage. Stick with me, this gets a little confusing. One provision determines the eligibility for coverage based on the date a claim is incurred and the date a claim is paid. Commonly used contract terms include 12/12, 12/15, 15/12, or paid contracts. These contracts define the specific time period the insurance company is responsible to cover a claim. Simply put, the first number describes when a claim must be incurred to be eligible for reimbursement, and the second number identifies the deadline for paying the provider. For example, if a group buys a 12/12 contract, only those claims incurred in the 12 months from the contract inception date and paid during the same 12 months are eligible for reimbursement by the insurance carrier. 12/12 is the least expensive stop-loss option, and because on average it has a considerably lower premium, it is often presented by consultants as the best option or sold to employers. This plan can result in a significant liability for the employer when a large ongoing claim is incurred at the end of the 12-month contract, but will not be billed, processed for payment, and considered paid before the 12-month contract deadline. Therefore, the employer is responsible for the entire claim. A 1215 will be more expensive but would allow 3 additional months at the end of the contract to pay the claim and still retain insurance protection. A well-designed self-insurance plan should include a transition between different contract types from year to year in order to cover the gaps of coverage that are created by simply repeating the same contract every year. For example, often after the first contract year, an employer may elect to purchase a paid contract, which ensures any claims be paid during the contract year, no matter when it is incurred. With numerous options of coverage periods, it is imperative you weigh the higher premium against the additional protection and select the right plan for your group. Ideally, the principal benefit to being self-funded is that you save money when claims are low, and conversely, you must prepare for the risk that sometimes the claims may be higher than expected. Employers who buy back risk from an insurance carrier can win or lose in the short run, but the opportunity to remove large carrier risk margins from your monthly expense will generally provide lower costs over time. There are many stipulations to consider before taking on a self-funded plan, but don't rule it out before you measure the possibilities.